The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Our next guest practices what he preaches, as he knows firsthand how important it is to protect your family from the unexpected. Since competing in a spelling bee on TV at the age of 10, Brad Ginet, a financial advisor, has now switched over to numbers. Welcome to the show, Brad.
Thank you for having me.
So tell me about this spelling bee.
Well, I was 10 years old and it was my television debut. I competed on a local news spelling bee. And I happened to notice that they misspelled the name of my school on the placards. So
isn't that ironic?
I think that's why we finished second.
And how did you make the switch into numbers?
My dad was an accountant and I always had an affinity for numbers, and he used to let me track his own stock portfolio, and that's where I got started.
And in addition to investments, you also help clients with insurance needs?
Correct.
So what are the big things that people need to know when talking about mortgage insurance?
There's a few different things. The first one is mortgage insurance will pay out the balance of your mortgage if you pass away during the term of your mortgage. And this is a very positive thing because typically a house is your biggest investment. Your mortgage will be your biggest debt. This is not something you want to leave your loved ones with if you were to pass away.
So are there other options than just buying mortgage insurance through your financial institution?
Absolutely. There's a whole suite of individual insurance products that may or may not fit your needs. However, there are a couple of key advantages. And the first one is typically mortgage insurance only pays out exactly what your mortgage balance is. So your coverage will decline as you pay it off.
So if I start a mortgage insurance today on a 25-year mortgage and it's $250,000 of coverage, but I only owe $50,000 towards the end, that's all they're going to pay me?
Well, they don't pay you, they pay the bank because they are retiring that mortgage balance, and your family is then left with the paid off house.
So if I buy private insurance instead, tell me how that works and what the benefits are.
You could buy a term insurance or any number of products, but the key element there is you get to name your own beneficiary and your coverage stays level. So in that exact same scenario you mentioned, if you passed away and you had a $250,000 term insurance, $250,000 would go to the beneficiary of your choosing. They would then have the choice of whether or not to pay off the mortgage or fund other needs.
So is it a lot more expensive to buy that type of insurance over mortgage?
The cost is similar. Might be a little more, might be a little less. Depends on the institution, depends on your age, health factors, things like that.
Speaking of health factors, how does that come into play with mortgage insurance? Will the bank, if you get ill, will the bank continue to cover you?
One of the coverages that is developed over the last 10 or 15 years has been critical illness insurance. This will pay out if you are diagnosed with an illness, and it can be part of some mortgage insurance, or you can own it privately.
Okay, so critical illness, that's separate. So if you become ill, you need to have this other critical illness policy in order to get paid.
Correct.
So why is it important to have critical illness coverage?
Well, what happens is we're just living through things we never used to live through before. Cancer rates are escalating. However, the survivability rate is also going up. And so you may experience costs that are not associated with traditional health care. For example, your spouse has to take off time from work to care for you while you recover.
Now, you've had some personal experience with this.
Yes, the accountant father that I mentioned was diagnosed with a major critical illness, multiple sclerosis.
Your dad?
Yeah, when he was about 40 years old. That's about what I am now. So
wow.
He had 3 children under the age of 12, was a successful accountant. However, he was unable to claim on his disability insurance through the CA Institute because he was not impaired enough to quit working. Critical illness insurance would have paid out on the diagnosis, not whether or not he was able to work.
So your dad did not have critical illness insurance?
He did not.
So how did he get through that?
He was fortunate enough that his disease progressed slowly enough that he was able to work for another 15 years prior to being forced to retire.
Wow.
So he got lucky.
So this is something that's very top of mind for you and your family, and as you're talking to others about this.
Correct. I've seen it with my own eyes, how these types of products should be done and how they can benefit clients and their families.
A lot of people think, well, it's not going to happen to me. That happens to other people. It's not going to happen to me. Or I can cover it myself. I've got savings. I'll be fine. What's your comment to that?
Well, as an advisor, we want to look at all the risk for our clients. And so, for example, if you chose to self-insure and you got diagnosed with a major critical illness, let's say you were going to take $150,000 out of your RSP to modify your home, allow your spouse to take time off, whatever that happens to be, that $150,000 withdrawal, if you include the growth through retirement, would cost over $500,000.
Wow. Obviously, depending on what age you are at when you do the withdrawal.
Of course.
But people don't think that far ahead, do they?
No, they do not. And the real additional benefit to privately owned critical illness insurance is you can add riders on there that will pay you back all of your premiums if you happen to not be diagnosed in 15 or 20 years. So you can have a client or another family member pay for this coverage, and if it happens that they are fortunate and don't have anything go wrong with them health-wise for a period of time, they will then recoup all of those premiums they've paid if they don't claim. So it really is a win-win for the client, and those recoup premiums can then supplement retirement.
So you get the coverage you need, and if you don't need it, you get a refund on your premiums. So your only cost in that case is your opportunity cost on what you could have invested it in.
Correct.
But for that peace of mind for a lot of people, I know myself, it's worth it.
I own it myself.
I want to go back to the mortgage just for another minute. If I buy mortgage insurance and I decide to switch financial institutions because I can get a better rate somewhere else, how does that impact my mortgage insurance? Can it move with me?
No, it cannot. And that is, another benefit of having your own coverage is not only will that coverage stay level, it will move with you from institution to institution if you change your mortgage. It is also convertible later. Maybe you have needs that go beyond your mortgage, taxes on your estate, for example, and you need permanent coverage. That term insurance can actually be converted without medical evidence to a permanent coverage later, which will help us and our clients meet their needs throughout their entire investing life.
Wow, so it sounds like the private insurance has a lot more flexibility and options and benefits, yet may or may not cost around the same, depending on health, I guess.
Yes. So
people need to have a look at this right up front, would you say?
Absolutely.
And what would you recommend as their first step?
Consult an advisor you trust.
And get some quotes on those insurance, and don't delay because you don't know what your health is going to do.
Correct.
Brad, thank you very much for joining me today.
Thanks again for having me.